Good morning, everybody. Thanks very much. Absolutely fantastic to see a completely full room here and having to bring out extra chairs for everybody, so that's great. Obviously, logistics continuing to be a really interesting topic for everybody. I know there were kind of 300-400 registrations online as well, so thank you to everybody also for joining us online. I'll be picking up your questions. Obviously, we're here in London, and a sad week in terms of the death of Queen Elizabeth. And I noticed on the Savills website there was a very simple message just saying thank you for 70 years of service, and I want to echo that as well from Real Asset Media's side. The session this morning is going to be focused on I guess the logistics markets, but also how we see that in the overall market, some of the trends that we're picking up. And we'll also be launching the second European logistics real estate Census 2022, and we've obviously been gathering. We've been helping with our clients, but obviously Savills Tritax have also been sending out the census and getting responses back, and it's going to be really interesting just to see some of that detail. And then we've got a fantastic panel as well to discuss that, and it's the joy of everybody being here is we can also answer your questions. So if you've got questions, please do answer those in the same. Please do ask those, and the same is true of that online. We're going to start off with three brief presentations, starting with Oliver Salmon, then Kevin Muffet, and then Marco Bornick. We're going to start by looking at, I guess, the big picture, then drilling down into the logistics, and then drilling down more into the survey, and then we'll pick that up all in the panel. So first of all, and this round of applause will be for everybody, including yourselves for being here. If you could welcome Oliver Salmon, that would be great. Oliver.
Good morning. So I'm going to take a few minutes to talk about some of the big macro themes that are impacting the logistics sector, to give a bit of some oversight into what follows later. And part of this comes under our annual impacts program, and this year we've looked at how real estate facilitates people getting together and reconnecting again after the pandemic. Firstly, thinking about where we are in terms of the macro environment. First, we had an inflation shock, began in 2021, where there were supply and demand imbalances in the post-pandemic recovery, and then exacerbated through an energy supply crisis driven by war in Ukraine. This has underpinned an interest rate shock, as central banks around the world have belatedly started tightening monetary policy. This has led to significant repricing in debt costs and volatility in financial markets. And now, increasingly, there is a concern and the realization that both high inflation and a high interest rate environment is going to weigh on economic growth. And we're now looking at a potential economic growth shock over the next 12 to 18 months. So to begin with inflation, I think it's important that we look at trends both in the US and Europe, because they are very different. In Europe, you can see here that the bulk of inflationary pressures are underpinned by external factors outside the control of central banks. So in this case, we can see that primarily it's all about food and energy prices. This contrasts in the US, where there's a lot more domestic inflationary pressure. Nevertheless, what we've got is central banks who have really emphasized that inflation is their number one priority, and they've started raising interest rates and will continue to do so over the next 6 to 12 months to get inflation back towards a target of 2%. So this really means interest rates are going to rise, and they're probably going to stay elevated for a good period of time. In terms of looking ahead on inflation, we've probably passed the peak in the US, particularly if you look at trends around supply chains, and I'll cover that in a second, but also domestic gasoline prices. Whereas in Europe, some of the developments around natural gas prices and also the depreciation in the euro, which filters through to high import prices, means that we're likely to see inflation rising in the coming months. Now, one thing that high inflation is really impacting is household incomes. And this is leading to a significant slowdown in consumer spending over the first 6 months of this year. And you can see this in the trend with retail sales, which has slowed down sharply. And also there's another factor in there with regards to rotation from consumption of goods towards services that's really hitting retail sales. And this is really what's driving the kind of revision in expectations around economic growth over the next 12 months. So thinking about where we might head to, well, one thing that is potentially a bad omen is the collapse in consumer confidence. And in Europe, and actually in the UK, US, and China as well, we've seen a collapse in consumer confidence to record low levels, below the trough seen in the COVID-19 pandemic, and below even the global financial crisis as well. But crucially, you can see here that there's a disconnect between the way consumers assess the general economic situation and the way they look at their own financial and unemployment situation. And that's really underpinned by the strength in labour markets. So consumers or households with this sense of job security have actually been subsidising some of their consumption through dipping into savings and increasing credit card debt. And the point here is really that the labour market is really key to whether we get a soft landing or whether we get something much worse, because what you'll see is that consumers will retrench a lot more if we see a significant deterioration in labour markets. Now, I mentioned about supply chains, and in the last few months especially, we've seen significant easing in supply chain pressures globally. This is underpinned by non-energy commodity prices. It's driven by easing transportation bottlenecks, falling freight costs. It's also underpinned by firms reporting much shorter delivery times. And this is part of the story around why we think US inflation has probably peaked and is starting to come down over the next few months. But one big kind of theme coming out of COVID is the idea of resilience, and that has driven a significant accumulation in inventories over the last 6 to 9 months, as you can see here on the right-hand side. And this has helped to provide a buffer against future disruptions that may come through things like zero COVID in China, through some of the kind of climate conditions that we've seen recently around drought, etc. And so those supply chain pressures should continue to ease, regardless of some of these other disruptions that may continue. Now, if just in case is the kind of short-term solution to building resilience into supply chains, then perhaps nearshoring is the longer-term solution. And indeed, there are probably 3 factors that we've identified previously are driving this kind of trend towards more nearshoring in the future. First is around economics. And what you see is that labour costs have risen quite sharply in a number of traditional offshoring locations. And also the proliferation of technologies such as 3D printing and robotics reduces the importance of labour in manufacturing. Second is the need for more resilience. Now, we clearly trade with a lot of high-risk countries in the world, and nearshoring production provides a way of reducing potential disruption around geopolitical events, but also around transportation bottlenecks as well. Finally, sustainability. So international trade accounts for around 20 to 30% of global carbon emissions, and as much as 70% of that is tied up in supply chains alone. So offshoring is incompatible with net zero targets, and nearshoring provides a viable option for firms to reduce their Scope 3 emissions. We looked at providing a nearshoring index that looks at how the shift might occur in production locations in the future if there was a more concerted effort towards nearshoring. We looked at 4 individual factors: economic, political, and business stability. We looked at economics around labour costs. We looked at proximity to local markets. We also looked at environmental and labour protection standards. Now, when you shift from a focus on offshoring that relies primarily on low labour costs to manufacture, and you look at a more equal distribution of weightings across the 4 different factors, you see a big change in the destinations that are attractive from a manufacturer's perspective. And that's really demonstrated by the shift from the blue markets to the more green markets there. So it benefits generally developed, stable, countries with good environmental and labour protections. And you can see that around Europe and North America as well are countries that will particularly benefit from a more concerted effort for nearshoring. In Europe, Central Eastern European economies such as the Czech Republic perform particularly well insofar as they give you a balance of low labour costs as well as some of these other stability around business operating environment, etc. Now, the death of globalisation has been prophesied before, but the evidence is still primarily anecdotal in nature. But if there is a more concerted move towards deglobalisation, the traditional kind of relationship between logistics demand would suggest that that would also impact demand in the future. But actually what you see is that there is a bit of a decoupling over the last decade or so. It's demonstrated here by the chart using US data, where we can see that demand has continued to grow over the last decade, despite relatively modest trade growth. And that's really underpinned by alternative sources such as data centers and e-commerce, which I'll touch upon in a bit. So this provides kind of optimism, particularly in some of those markets that would lose out due to concerted efforts of nearshoring production, because these markets are typically underdeveloped in these alternative uses, and therefore provide areas to grow in the future. Now, I mentioned e-commerce there. One of the big drivers of the growth in the sector in the last 2 years has been this expectation of a step change in e-commerce. But interestingly, in the data, that certainly in aggregate level, actually e-commerce penetration rates have actually fallen back to broadly pre-crisis levels. And you can see there that there's a very strong correlation between penetration rates and mobility. So consumers have started to return to physical retail once the restrictions on their activity were lifted. But at a sectoral level, there is some persistence still in more physical retail sectors. So electronics and clothing, for example, more suited to e-commerce and online retail. And this makes sense if you think about the amount of investment that firms have put into developing online platforms, and they'll be very keen to realise a return on those sectors in the future. And finally, before I pass over to Kevin, I just wanted to present a summary of warehousing costs. We looked at this back in June this year, and across 52 markets that we covered, we saw an average growth in warehousing costs of about 8.5%. At the top of the list, we have London, supply constrained and a very diverse use of logistics in the region. London and the UK more generally is obviously compares favourably on e-commerce penetration compared to many of its European peers. Hong Kong, Tokyo also near the top, again land constrained major global cities. Thinking about a regional level, in the US, the region has seen average growth around 20% in the last year. This is underpinned by very low vacancy rates, particularly in coastal areas. Whereas across Europe, the average growth is around about 7%. Now that is broadly in line with inflation, but clearly there's quite a lot of difference across different markets. And you look at Prague there, for example, we mentioned the attractiveness of the Czech Republic, and growth in warehousing costs over the last year have risen by about 35%. And with that, I'll pass over to Kevin for his presentation. Thank you.
Thank you, Ollie. For those of you who don't know me, I'm Kevin Moffat. I head up UK and European Industrial and Logistics Research for Savills. I'm a very short slot, somewhere between 5 and 7 minutes, to give you an overview of what's going on in the entire European logistics market. But that's because we want to focus on the panel and the results of the census. Really interesting what Ollie said there about Prague. I've been talking, writing, analysing the markets for a long time, and those of you who have seen me present before will know that my focus has always been about vacancy rates, because we did some analysis looking at the UK, and rents have never increased when vacancy has been above 12%. So that's the kind of tipping point where we go from a landlord's market to an occupiers market. So Prague, it comes as no surprise when we hear the increased costs there. Prague has a vacancy rate of 1%. So my my whole worldview really is driven by what vacancy is currently and what vacancy could get to in a worst case scenario. When the Amazon announcement came in April, my phone started ringing off the hook. So I started doing a load of analysis, and just for the UK, by the way, we have a vacancy rate of 3%, and even if Amazon went bankrupt, which they're not, but even if they did, we still wouldn't get to a vacancy rate of a double-digit number. So that is the cushion, that gives us some security, even if we are heading into a period of economic volatility, as the slides from Ollie demonstrated. So I think I've used up almost half of my slot there with that kind of opening gambit. But I'll rattle through now some stats. Just to put everything into context. Last year was a record. 38 million square meters transacted occupationally, 62 billion euros invested. So just to put into context where we were last year. This is my kind of standard opening slide at the minute. For the last 2 years, 3 years, we've been talking about tailwinds that have propelled our sector forward. I'm not going to focus on those today, and Ollie's done a really good job of telling us the headwinds. My role now really is to consider, well, how strong are these headwinds? How long are they going to last? And how are they going to impact our market? And if we just look at the data for the first half of this year, occupationally, over 20 million square meters transacted across Europe. And that's a pretty fair balance between Q1 and Q2 as well. We haven't seen any drop-off yet in occupier demand. If we take the UK, where we have good data on requirements, actually requirements fell only 3% year on year. So we still have a amplified market, even with the occupiers still looking to take new space. It's going to be interesting to see how that trends forward in Q3 and Q4, because even if we are getting data on an elevated number of requirements, there is of course no guarantee that they translate into a deal. But that's what our panel is going to examine in the Census. Just interestingly, where is the take-up happening? Well, this is 22 take-up by market, and some interesting trends there. You look at Germany, the Netherlands, but also smaller countries by capita. Czech Republic accounting for 7% of that demand. So really interesting to see where that demand is falling across the continent. Now, I made the point about vacancy earlier, and I'll just double down on that. We have a vacancy rate of 2.9% across Europe. And many markets that we cover are even lower than that. It's worth reiterating that when we were in a similar stage of the cycle in the UK, we had a 12% vacancy rate in the UK. That's when take-up really started to explode in the UK. So now in Europe, you have this almost double whammy of a structurally low, historically low record vacancy, but yet we are seeing the demand rise. And I'll come on to how that impacts rental growth, because these are the forecasts from Capital Economics, 1.6%. That doesn't feel right to me. And this is focusing on macro drivers, consumer spending, GDP, etc., etc. And if we just look at the rental growth we've seen across Europe, over the last 3 and 5 years, again, it's outperforming what the forecasts were saying 3 and 5 years ago. And it's that relationship between vacancy, demand, and requirements that the forecasts often miss, because, frankly, logistics has been so under-researched for so long that we don't have those long time series of data to really help enrich the forecast. So for me, that focus on vacancy is key. Now that's feeding through into the capital market side of things. We've had almost 30 billion invested so far this year. In fairness, the vast majority of that was in the first quarter of the half, rather than the second half. And I know, my colleagues, Marcus in particular, will focus on where we expect investment volumes to be for the second half of the year, and pricing as well, because we have had pricing come down to record lows across all markets. In the UK, we've moved our prime yield out 50 basis points with upward pressure expected. So again, we'll focus on where that's going to settle. Price discovery, if I had a pound for every time I've heard that phrase over the last 4 months, but that's the mode we're in at the moment. Now, a couple of points just to wrap up. And you almost have this dichotomy at the moment between certain consumer indicators telling us that we should expect a fall in demand, but then you have some more structural factors, which I'll just talk about now. Build costs, cost of debt. We are already beginning to see less speculative development announcements. Now, the knock-on impact of less speculative announcements, even if we get take-up slightly less than what we've experienced over the last 2 years, that suggests to me we're still going to see a low level of vacancy because development is going to be lower. If we have that low level of vacancy, we do have more chance of getting rental growth. Now, the online retail piece Ollie mentioned, this was a forecast from Forrester which we buy in. It was produced at the start of 2021. It's suggesting that we're going to get to 25% online retail across Europe by 2025. I think that's a stretch now, given the economic situation. It may well be 27, 28 that we get there. But the trend is still heading that way. And part of that is simple demographics. You know, a 40-year-old of today, by the time they're 50, will spend more online than a 50-year-old of today. So part of that is just simple demographics, that trend will continue. Last 2 points, nearshoring. Ollie mentioned it. This was a fantastic data set I saw in the FT, and I reached out and asked the company who provided it with the data. They analyse annual reports for listed companies, and we can search for nearshoring, reshoring, friendshoring, whatever terminology. So we amalgamated all of that together, and you can see it's exploded over the last 6 to 12 months. So again, does that mitigate for any fall in demand we'll see from online retailers? I've probably used up my time, so I'm not going to talk about the conclusions. They're pretty clear, I think, from what you can see. Occupier demand so far is robust. Vacancy remains low. However, we need to be mindful that we expect to see a drop-off in demand, particularly from the online retail segments as they navel gaze about the future. However, we are seeing extra demand come through from manufacturers, people looking to do nearshoring, reshoring, and so on. So with that, I'm going to hand over to Mark for a whistle-stop tour of the results of the census, and then we'll get on to the panel. Thank you very much.
Good morning, everyone. Thanks, Kevin, for those fascinating numbers there. I'm Mark O'Borwick. I head up the research team at Analytica. I've just got 5 minutes or so to talk you through some of the key findings from our European census this year, with a particular focus on the occupiers market. A couple of slides to start with, just to set some context. 5 or 6 key metrics on warehouse space, and then a couple of slides just to finish with a more forward-looking perspective. So first of all, occupier insights. We conducted a survey over the summer months. There were almost 460 respondents. Around a quarter of those were from the occupier segment. And then delving more deeply into that, just under a quarter of those were logistics and parcel operators, with the remainder split quite evenly between retailers and manufacturers. If I had to sum up occupier sentiment, I would say long-term optimism and confidence, tempered by short-term realisation of the headwinds that everyone's facing at the moment. So if you look to those dark blue bars on the left-hand side there at the top, understandably, more occupiers this year are finding things more difficult. Around half of respondents are. But looking on the right-hand side there on the chart, we see around a third of respondents, quite evenly split between the different audience groups, and also seeing things as more favourable than they were this time last year. What are occupiers' key concerns at the moment? Starting off down towards the bottom, you see the availability of warehouse space. Last year featuring third, I think, in the rankings of concerns. This year it's dropped down to 8th, overtaken by those more macroeconomic headwinds, if you like, and concerns at the top of the chart there. rising costs, the availability of labour, economic uncertainty and consumer price issues, all considerably up in terms of their level of concern than they were from this time last year. How is that now then impacting on demand for warehouse space? And I think it's pleasing, very pleasing to see. Still 90% of occupiers expect to have or require the same or more space over the next 3 years. And that demand profile is quite evenly split between the three groups, although it is the logistics providers perhaps slightly ahead of the other two groups. We see there on the right hand side almost half of logistics providers and parcel operators, 46%, expect to increase their level of space over the next 3 years. Where are they going to be looking for that space? Well, unsurprisingly, the core markets, as Kevin and Oliver have touched upon, feature most strongly. We have France and Germany there at the top on the left-hand side. And again, as both alluded to, these consumer trends now are rippling and expanding across Europe, and we're seeing the more peripheral markets experience strong growth. We see Portugal there on the left-hand side, one of those key markets, albeit obviously growing from a much smaller base. What challenges are occupiers going to face in acquiring that space? Again, looking to the dark blue bars on the chart on the left-hand side there, we see facility costs, the location of the facility, and this year the negotiation of contract terms all perceived to be much more difficult this year than they have been previously. On the right-hand side there, we see cost and location feature prominently, as they always do, amongst occupiers' key concerns. But this year, the negotiation of contract terms, particularly in markets that are weighted towards the landlords, are proving more challenging. What size of facilities are occupiers looking for? This year there was a slight relative increase in the popularity, if you like, of urban logistics sites, but that was almost exclusively led by the logistics providers and the parcel operators building out their networks. On the right-hand side there, we see that the demand or inquiries for the larger facilities, the mega box facilities, are led by the retailers and the manufacturers. Looking at the features of warehouses that are important to occupiers, it's not unsurprising, it is unsurprising to see cost and contract terms, the flexibility in leases featuring highest in the rankings of their concerns, the features they think are most important. That's something we saw in last year's European Census, and we've seen in the 5 or 6 UK Census projects that we've undertaken. For us, it's quite interesting and pleasing to see environmental sustainability issues feature sixth on the list of priorities, as they did last year. Sorry. So after the core elements, if you like, the core elements of building cost, of the contract terms, followed by ensuring that you have the availability to operate your warehouse, sustainability features really are cementing their position as one of the highest priorities now for occupiers. How sensitive are those occupiers to rental price increases as opposed to other rising costs? Again, looking at the bottom there of the chart on the left-hand side, the dark blue bar, unsurprisingly, we see a lot more occupiers this year are very sensitive to those price increases. And looking on the right-hand side, again, whilst there's not a great deal of difference between the different audience groups, it is the lower margin logistics sector that is more price sensitive. Now, just 2 or 3 slides to finish up with, looking more towards a future perspective. We asked occupiers what they thought of European supply chains in general, so not just focusing on their own operations, and how will those develop and evolve in the years ahead. And again, as Oliver and Kevin alluded to, the focus is on risk management, underpinned by investment in technology. We've seen there that people expect supply chains to shorten, there'll be more staff home working, and there will be investment in IT systems, particularly improving the visibility of supply chains. How will that impact on their own specific operations? Well, we can see here almost 40% of our occupiers expect their company to increase the quantity of stock that they hold. There will be, interestingly, more investment in building level automation that will filter down from the largest operators down through the mid-tier and even smaller operators, and supply chains will shorten. The evolving evolution of supply chains is driving demand, as we've seen, for more space closer to the home markets. And finally, just a word on future challenges. We asked the audience base, excluding COVID, what is the biggest challenges they face in terms of their property-related issues. And for occupiers, as you can see on the left-hand side there, rising rents and the lack of supply of future buildings are the key concerns. And those concerns are shared by the wider audience base, as we can see there on the right-hand side. Investors agree with occupiers that rising rents are the key challenge, while asset managers, agents and advisors look to the lack of supply of future buildings as the key concern. Developers' concerns focus around the planning systems, while for landowners it's managing the future power supply to their assets. So yeah, that's a very brief whistle-stop tour to our census of this year. Thank you very much.
Thanks very much. Really interesting. Really interesting. 3 different presentations there. Ollie, interesting around the challenges there, because that definitely picked up. And Nick was there in Paris with me late last week for the EPRA conference, where the first 2 presentations couldn't have been more depressing if they'd tried. But particularly on the challenges, with Professor Rabini, just highlighting a lot of the global issues. But actually, in the last 5 minutes, coming around to the fact that actually it may well be positive for real estate. And I was saying to Nick earlier that I might have rebalanced that presentation, given that it was a real estate audience at the time. So we're now going to discuss some of those topics in the panel. So if the speakers could join us, that would be great. You can sit wherever you like. And of course, if you've got questions, just raise your hands, shout out, whatever you would like to do. And if you're watching online, you can put your questions in the chat, and I'll pick them up. Very interesting to pick up, I think, as well, Mark, on some of those in the census, and a lot of focus that we've had in our discussions around ESG, and it's interesting to see some of that being picked up in the presentations. What were the standout points from the census, particularly for you and looking at your business? And let's start with you, Mike.
For me, a sense of pessimism in that presentation. But actually, this is one of the most exciting times. This is a good time to be in logistics, real estate. Actually, I think we're going to have a lot of fun over the next few months, because it's always in periods like this that it's creative. Destruction is creative, and the low-hanging fruit is not there. What is there, a real specialist, is the opportunity to find value. So I see the presentation, many good points in terms of market sentiment, but I think for investors and developers in the real estate sector and logistics, this is going to be and continue to be a very exciting time. If anything, better now than ever.
Okay, well, let's pick up your view.
Yeah. Occupationally, through our business, we are seeing significant requirements coming through from our client base, and those requirements in part are increasing. So that side of the story seems to be relatively robust at the moment. It's more a financial sentiment scenario which is causing the uncertainty as the headwinds we've looked at. And I think with all these investments, if you've got target, focus, understanding as to where you're looking, and a key theme to drive with, I think there's going to be a real opportunity to Michael's point coming through this. I think the simplicity of buying, building, logistics building, and watching rent grow, and the yield compressors thankfully moved on, and it's actually going to be a little bit more insightful now, and people's ability to drive value is going to be through quality of building. Key focuses, sustainability, that are something we've been encouraged to look at the highest level. So we've come out and made those statements that our buildings will have to be very green, very ESG compliant. So I think hopefully this this will be a driver of change as well as everything we've seen. I appreciate the cost implications of that, but you know, the occupational side of things, we're getting more push to having greener buildings. It's come one of our differentiators when we're winning business as well. So it's an interesting time.
Okay, good, Nick. Let's get your take on it.
Yeah, I echo some of the comments from Mike as well. I think that this whole split between capital markets,
Might want to be a tiny bit closer.
the split between the sort of capital markets and the macroeconomic impacts that we're hearing about, which are obviously very challenging, but then split that out and look at this from the occupational side. I think that's what the census is revealing, is that also Kevin's slides around the supply situation in most of these markets, that vacancy rates remain low, the occupational demand is still there, and we're still leasing properties, we're still pushing rents upwards, because the choice just isn't there for the occupiers. They are moving their businesses to a more omnichannel online retailer. All the supply chain resilience points that we've heard about, but we're hearing this all the time from our occupiers. It is happening. It is this real disconnect from macro, where obviously the numbers are green, but it's still fundamentally believe right that we're in a very interesting time going forward. And I believe that from the income perspective, we're very well placed for the long term.
Okay, good. Let's just pick up your views there, Marcus, as well, just in terms of I suppose some of the key takeaways for your part of the business from the census.
Yeah, I mean, I think probably we got used to good news. Everything we ever turned up to was good news, and any room you were in was debating whether it was going to be 10, 12, 14% rental growth, where vacancy rates would get to. Could Paris do the same rents as London? And that was what we were kind of used to talking about in every event that we ever turned up to. And so the first bit of bad news shocked everyone, and probably kind of sent it a little bit skewed too far the wrong way. Because actually when you sit and listen to all of this, the supply and demand dynamic is still incredibly favourable, and adding to some disruption, of which there will be. So, beginning of this year, we were looking at a supply crisis. Everyone was worried about how we were going to build enough warehouses to justify the demand coming through. Well, now we've got reduced supply, maybe some upset in demand, but a long way to go before you get off a growth trajectory, even if that growth is dampened slightly. So, I mean, we'll come on to the capital markets bit, which I think is a separate subject, but dealing with the census and what's in front of us here, I think there's a lot to be positive about still.
Okay, good. And Nick, I wanted to pick up the ESG point with you. And again, I'd be interested in everybody else's views on that. I mean, I was interested to see that actually it was still sixth, which was interesting, but interested to see that it hadn't moved, but still a big focus on it. So I suppose, where do you see that going? Although that hasn't maybe moved there, are you seeing a growing focus on it from your investors, for example? How's ESG working from your side, particularly the zero carbon part?
It's across all of our business, whether it's investors, as you say, but also will say the occupier side of things as well. But we're seeing a real enhanced interest in this now. From ESG, we're looking at it from the environmental side, whether that's energy efficiency, social side, it's all about having good workplaces, all of this type of integration of the community. ESG is very sort of multifaceted from our perspective. We're really seeing this out for the occupier side. We're doing a lot of work with tenants across the portfolio to improve that. We're also seeing this from the development side, the spec is improving all the time. That's where it comes into the net zero carbon piece as well. More and more focus on this in terms of meeting the long-term targets and the short-term usage as well. So it's multifaceted. I am surprised it went so well. I think in the order, but it's consistent. It's always there, and there's so many different elements to it. As I said, it's energy saving, it's high quality workplaces,
Okay, good. And will it be good to pick up from your side, because I know that DHL especially have been doing quite a lot in terms of both of the the fleets of vehicles and particularly the carbon neutrality has played a big role for DHL. So maybe just highlight what's happening there and what are you looking to do in the future?
Yeah, so in terms of our buildings, we've been certainly the challenge originally was 2030 during COVID of carbon zero. That's been sort of pushed to 25. Whether that will still be achievable with the variables we've seen over the last 6 to 12 months will be clear to everyone maybe in the next 12 to 18 months. But that is a corporate banner. We're working to that, and it's not just real estate. Obviously, as we've been taking over new jets that are more fuel efficient. We've got fleets of electric planes to facilitate shorter haulage. We've got liquid natural gas trucks, hydrogen trucks on trials, electric fleets for smaller vehicles. So across the board, we're sweeping through. But to the wider ESG point, I think one of the challenges with it is at the moment it is too broad a church. It's got too many elements. It almost needs to be stripped out into its constituent parts because they're all of equal importance. But to be bucketed under one kind of detracts from each individual element. It has so much cross in it. The environmental side, solar PVs, other renewable energy sources on buildings. That also goes to the market or operational cost saving when you've got energy costs going through the roof that they are now, which would be a nice byproduct for those people who have established those buildings. You've got all these other factors, wellness for employment. Many geographies are struggling with good employee base. Having a very nice place to work is key in every environment. So I think all of these points need to have their own sector almost within people's approach to the topic. But it's fundamentally, there aren't many occupiers or clients who we end up delivering buildings for who don't have it on their agenda somewhere, because even if it's not the direct operations or procurement team, the investors in that business will have the same demands as the investors in the real estate that we buy and also in our business. So I think I'm surprised as well it's not quite pushed up beyond the sixth place, but it's definitely growing.
Okay, great. And I'm getting some. Although everybody can hear you in the room, there's difficulty hearing you unless you hear the speakers connecting. So unnaturally close to the microphone is probably the best the best version of it. It'd be interesting, just from your point of view, Mike, in terms of particularly the sustainability part of it. I suppose, what are you doing in terms of future-proofing? What's driving that? Is that the occupiers? Is it regulation? Is it that idea that you want something future-proof?
I think we heard three really good answers. On the topic of ESG, clearly it's not just about solar panels and staff wellbeing. It's such a huge topic, and this is much really about social justice and transparency, etc. Much bigger topic to split apart. But clearly, the focus on the quality of buildings is very important to both our occupiers and to our investors. Critical, and that will just continue, and that's a good thing. But what I would say is one of the most key focus trends for us is to redevelop brownfield sites and focus on infill brownfield. One, because from an ESG point of view, environmental point of view, that's a good thing. And secondly, it's a tremendous commercial opportunity when you can find locations, edge of urban, which fits into our speculative urban logistics program across Europe. These sites are fantastic in terms of accessibility to consumers, roads, infrastructure, and I think a greater emphasis going forward in the future will be on redeveloping, repurposing brownfield sites. I think across Europe, we're in a very different place than we were only 6 or 7 years ago, or even 4 years ago. We've got municipalities in the principal economies such as Germany who are very resistant now to zoning land for logistics use. Netherlands have introduced, for example, extremely tight nitrogen requirements, which are impeding any progress on greenfield zoning. And that's actually a good thing. and it's part of that, I think, drive that pushes creativity in our industry. I think we were at a conference at Expo, in fact, panel in Expo, and you asked the question, Richard, about lack of development sites, and I said something along the lines of, yes, another developer moaning about the lack of development land. Developers moan about lack of development land in good markets and bad markets, but the truth is, there's tons of opportunity there to repurpose land and to be creative. I think the move forward now in the environment that we have and the codes of conduct in terms of ESG will see far more focus on brownfield regeneration, and it will be those teams that have the best technical construction nous in-house who really understand the sector that will succeed.
And I mean, one of the sessions that there was at EPRA was actually from Anders Rasmussen, who was the ex-head of NATO, ex-Secretary General of NATO, and he was saying very clearly that along with the friendshoring side of it, which he actually mentioned in terms of supply chains, but also energy resilience is going to be very much key. And so that move away. How important are you seeing things, and I'll pick up that with you as well, Nick, how important are you seeing aspects like being self-sufficient in terms of energy through solar power or through whatever means?
Absolutely, Richard. I mean, it's taking our scheme I-Port in the UK, which will be circa 6 million square feet. We invested heavily in the power infrastructure and preparing all buildings for PV. And that, across Europe now, we're developing PV on some of our larger buildings. I think energy resilience is just going to be more and more important over the next 10 years. Clearly, the gas crisis, the energy crisis has focused all minds on that. And certainly, gas is not featuring in our new developments. Fossil fuels are not featuring.
Okay, good. And Nick, interested to pick up your view on that, and also maybe on the, I suppose, on some of the more social sides of it, in terms of, because there's a big focus on carbon neutrality or positive carbon, but there's also a focus as well on well-being and those kinds of things, which we were talking about as something surprising coming from Asia about 4 or 5 years ago, and very much seems to be a topic here as well, reflected in the census.
Yeah, let me talk about the energy piece first, Richard, and we'll talk about the social bit in a minute. On the energy side, I completely echo Mike's views on this. It is becoming more and more important. We've known this for a long time. The recent crisis that we're seeing in terms of the energy prices spiking is just bringing it into sharp focus. This is something that we're looking at to try to act both in the Eurobox, but also in the big box, as a manager of funds. And on-site generation, we have at our disposal a large number of very large assets in key locations all across the UK and Europe, and those have potential for energy generation. Yes, the simplistic part is PV, but it also goes beyond that. And we are working very, very hard on that. I think you'll see a lot more from us over the months and years in terms of providing more energy resilience, not only just to the occupiers, but also feeding back into the grid. I think this is a macro trend that we're likely to see, of more micro generation, generally less reliance on a very small number of very large generating power stations. I think that's one of the things that will come out of all of this crisis. Excuse me, it was a direction of travel anyway, but I think it's all accelerating. The other point on social, and again, Mike's absolutely right in terms of more focus on brownfield development. It's all about working with municipalities. The social pieces goes way beyond what we were just talking about in terms of having a decent place to work, which is to ensure staff retention. Those factors that we consider as a key one. So staff retention, absolutely, but it's also integration with local communities. We've heard and we hear it all along that municipalities are extremely reluctant to zone and permit land for these very large logistics buildings. They're perceived to be polluting, what's grime, what's eyesores, etc., etc. So community integration is a key part of how the permitting process works now. So working with municipalities and local populations, bringing them on side and to the benefits of these buildings is key. And so I think we see more and more of that going on as well, alongside all the other, if you like, slightly more mainstream and more high-profile ESG components.
Okay, good. I wanted to pick up with you, Marcus, if I can. I mean, feel free to pick up any other points around ESG, particularly resilience, and how that may be influencing the capital market side, particularly in terms of valuations going forward. But it would be good, I think, the census highlighted, that there was still almost 90% of investors seeing themselves as adding more space. So I suppose, how do you see overall investment volumes moving, and also what's going to happen with yields? I mean, what's your sense of that? So I suppose looking towards pricing, volumes, those kinds of things, how do you see that moving?
Yeah, so I think we've almost got to look back to what's happened. So, and almost go back 12, 18 months and remind ourselves where we were at that point as we were coming through COVID. And, logistics was top of everyone's shopping list. We were not in normal market conditions. 50 bidders, 40 bidders regularly on processes from an array of different investors that normally would have very different outlooks, very different approaches, all competing against each other to get to record prices. Each and every process was going higher again, higher again, higher again. And so logistics was bid to a level where it was only just about working. Quite often we heard, right, what's the price we need to pay to secure this, and then let's back solve the underwrite. But I think, and there was growth there to support those numbers, so it did make sense. I think the problem is then we approach this year, you started to see sentiment turn January, February, but there were still deals going on. We were closing deals sub 3% on new build 10-year income, in Q1 drifting into Q2. But then you had this shock wave, the swap rate movement, where suddenly 100 basis points in a week, huge volatility. And everyone just took stock. And I said, as a general rule of thumb, any processes at that point in exclusivity got done. And I think buyers were able to go to vendors and say, look, we're at the limit that we could afford to pay for this anyway. We're not changing our underwrite, we're not being greedier in our returns, but our costs have gone up and we need something off the price to account for that. And those conversations actually were probably, more accommodating and better than people probably envisaged. They thought that the vendors might be less understanding, but I guess they saw, well, we're in a super profit anyway, and it's probably not going to get any better. So we're a bit more pragmatic. The number that was in terms of a discount ranges, and it's probably not right to give you a specific number, but anything from no discount at all the way through to 20% being accepted. After that, though, I'd say any process that was launched after the event, that's where you've seen, greater uncertainty, and everyone's talking about this kind of bid-ask spread that we're all struggling to bridge at the moment. And I guess the reason for that, as you get around and talk to investors, is that it's now not just the higher debt costs. They're also then looking, having to change their underwrite. One of the hardest things, which none of us can say today accurately, is what the exit yield should be. What is anyone going to be selling out to in 5 years' time? I think we all just accept that real estate as a whole has to get cheaper or more attractive from a returns point of view to stay, good value attributable to other asset classes. So 3% yields seem like a thing of the past for a substantial period of time. So 4, is it 4.5, is it 5, what's the new rebase? But I think that's what everyone's working towards at the moment. You then look through into what's going to happen through the rest of the year, and I think, from all the conversations we've had, everyone's just reverting to type a little bit more. So if you look at the back end of last year, you had core processes with highly levered core plus buyers beating off, your traditional core buyers, the pension funds, the insurance companies, etc. Now, again, that wasn't normal. We have to kind of remind ourselves of that. And actually, all that money seems to have had to disappear a little bit off into the long grass, whilst their cost of capital's just shot up. And then, encouragingly, and it is really encouraging now with the meetings we've had over the last week or two, the institutions are keen. They want to keep the wheels turning. They want to keep spending. They've got money. That's the overriding kind of theme as you get around and talk to everyone. They've got to see a discount to peak. It's got to work for their numbers, and they've obviously got to kind of push it through their ICs where they're going to be scrutinised. But they've got money and they want to spend it, and they want to spend it in logistics. I think then, to finish before we hand over, also when you go around those big players, the guys that have driven our sector forward over the last 5-10 years, I'd say they're reverting to type as well. I think, you can read it in the press, and I'll refrain from specific names, but some big global equity houses that, are back raising lots of value-add opportunistic money, moving away from core REITs that had distracted them for a period of months last year. And they obviously see a lot of opportunity coming down the line. So where that comes from, where the distress comes from, it's hard to see. There aren't that many pressure points, but I think there will be opportunities, and I think then, it's going to be quite a fluid market. But to finish, I can't see it rebounding immediately in terms of volumes. I think this year will still be a little bit softly, and then we'll see how we go going into Q1, Q2 next year.
Okay, good. Nick, let's just pick up also on, feel to pick up on any of those points, but also on the fact that 90% of occupiers were saying they were looking to extend space. It'd be interesting to see what's driving that in your view, particularly for your area. And it was interesting to note that retail as well was a big part of that, and we've certainly been seeing a lot more in terms of the demand for retail warehousing. So try that. We'll also try what is Marcus's technique of holding the microphone very, very close and see if that works.
I'll try and improve, but on the capital market side, I agree with Marcus. I think this year is likely to be fairly soft. I don't think there's a huge amount of transactions. But bear in mind, and I'm echoing what Marcus said, that the logistics, real estate generally remains attractive. When you're looking at the main sectors in the real estate space, logistics is very appealing, in particular compared to the office sector, the retail sector, for all reasons we all know about, in terms of oversupply retail and who knows where office occupancy rates are going. Whereas logistics, all of the issues we've been talking about today, the fundamentals, which all lead through from the shift to online retailing, the whole reshoring and more resilience in supply chains, desire for businesses to hold stock closer to customers. These impacts are all really positive ones for the long-term income generation and growth in the logistics sector. And you can't say that about retail and offices, through major sectors. And that is one of the reasons why, as I said, there's still a lot of interest. Yes, the macro picture is very uncertain at the moment, and therefore people are being cautious, but we do think that the investment will come back. There is a repricing going on as we speak. We're not quite sure where that's going to end up. But the fundamentals, the income generation capability of high quality logistics in Europe is still very good, and those investments are fundamentally, that's what real estate investment is all about, is long-term income generation. The capital market side we can't really control. Therefore we have to operate alongside that. So what we're doing is just really focusing on the day job, leasing up assets, managing them well, generating strong income streams out of them. And we're still pushing rents up, as we've said before. We're getting good indexation coming through on leases, which is another key driver of these European logistics leases, annual indexation, capturing a lot of the inflation that we're seeing at the moment, which is a real downside potential as well. So there's lots of positives, despite, as we said, the sort of, the really quite sort of bleak in a lot of ways macroeconomic.
Okay, good. And we'll obviously DHL a large occupier also, but you're on the capital markets side. So are you seeing as well? We can see the demand there. Are you seeing that coming through in terms of leasing?
So yeah, fundamentally, I've alluded to the fact that our client base is increasing in terms of the conversations I'm having with our developers across the region. Some very big corporates who are looking on a longer horizon than the immediate impacts we're seeing, trying to future-proof a supply chain or rebase the supply chain for the next 5 to 10 years, and those requirements haven't really come off yet. There are some local impacts we're seeing, so existing client base within a single geography where people have started to pause very few, but a couple of our conversations. Beyond that, we're still driving quite a significant pipeline of development because we've got that occupier base behind us who are knocking on the door for 24, 25, 26 delivery based on either renewing existing facilities to get to our carbon neutral position in our gasless green buildings that we're creating, or actually fundamentally it's new business coming through, and whether that's people looking to third-party supply chain solutions as their uncertainty of the resilience of their own capabilities in delivering it. I don't know, but maybe that is the case. But there's definitely no sign of it dropping off a cliff. So fundamentally, it feels like we're still fairly robust on the occupation side, and there doesn't appear to be a lot that's pointing to that changing, regardless of the headwinds that we've seen. Clearly, there will be certain geographical variations. There's certain parts of the market where it is felt, slightly more secondary locations perhaps, but the core sort of fringe locations, as Michael talked about in terms of those brownfield, infill sites, will probably still have high demand. But yeah, occupationally it feels strong. But the capital markets piece is the bit that may actually end up limiting it in terms of the delivery of space, which will be a frustration if we can't create new buildings to get our client base into because the economics don't stack up.
Okay, good. Mike, just coming to you, I suppose you mentioned their availability of sites and those kinds of things being an issue. Price, rising costs was highlighted quite a lot in the census there. So I suppose, how do you see that, and is that going to be limiting future development as well, because there's an uncertainty of pricing, but also obviously financing costs?
No.
No.
Clearly, we've had some real inflation in the industry in construction costs, spiking particularly in spring, and shortage of materials and supply chain constraining key components in construction, the Lane programme. But to a degree, that spike's been flattened. I mean, yes, there is inflation in the system, but it's manageable. And again, it's manageable if you've got the right technical construction capability. You can navigate that. Quite helpful that Amazon have pulled back many of their planned developments and their program in Europe. It's good news. It's pushed some capacity back into the system, because some of that overpricing construction was in fact linked to capacity, not simply materials. So I wouldn't say inflation is still in there, but it's you know where the ceiling is, and you can navigate that in your investment and development approaches. So yeah, we're comfortable with that, and of course it's all part and parcel. I'm going to use Kevin's expression, which has been used widely, of price discovery. It's all part of that landscape we're now in, where there is opportunity to be creative and to those with capital to secure really good opportunity and create value again. Because where was the value going to be created with a never-ending growth in value and never-ending supply of people entering the market to play the game of logistics investment and development, which makes everybody look a hero when yields depressed and wipe away mistakes. So here we are in a real market with proper challenges, macroeconomic conditions uncertain, but it's a fantastic market in terms of occupier demand. We're seeing double-digit rent inflation. in the markets that we're choosing to work in. We're seeing very strong occupier demand, particularly in urban logistics. It's an overused expression, but let's call it best-in-class inventory stock, developed edge of towns to serve B2B and B2C. And it's that way you're going to see great rental growth. We're seeing really good take-up. And we're not focused on long leases, we're focused on dynamic investments that generate income and will always generate income and generate rental growth, as distinct from large boxes at the edge of motorway junctions, less than 20-year leases with a cap and collar, which increasingly look unattractive from an investment point of view. So sorry, went round the houses there, Richard. But yes, there's cost inflation, but it's now manageable, and it's all part and parcel of making carefully considered investment decisions, and using it to your advantage, investing well now.
Okay, great. Nick, I wanted to just pick up with you briefly just in terms of the locations, because we had France, Germany, obviously were key locations there in terms of the market. What are you seeing there? I think you've just recently bought also in the Nordics. So I suppose, what are you seeing in terms of the markets? And are you looking at different markets? What's your sense of the attractiveness of the various markets?
I echo a lot of what Mike said in terms of actually just stop that actually we're not looking particularly to the countries that we must be in, must be in. It's about where the logistics infrastructure is. It's all about population centres, exactly as Mike was just saying, about in key locations on the edge, close to population centres where the occupiers can deliver rapidly, accurately, cheaply to their customer base, whether that's retailers, streets, business to business. And so it's all about those locations. It's about having high quality buildings, the right location, good infrastructure, good power connectivity, all of that type of thing, allowing for operating efficiently. And so we're not particularly focused on necessarily country by country. It's all about those type of population and infrastructure country by country. And yes, we are working with Virgin at the moment. It's very interesting seeing as I saw that. Hopefully that will be evidence of what Mike was talking about in terms of driving rents forward. And the other point, just on all the pushing rents forward, that all of the things that we were saying earlier about landfill development, this is more expensive to do as you deduce from what he was saying. Fundamentally, the more it costs to develop these buildings, the higher rent has to be passed on to the occupier. And coming back to your original point of all this, in terms of the survey, that occupiers are basically complaining about higher rents and very focused on the occupation costs. Yes, of course they are, but the fundamental is there really is very, very little choice for them. And we've seen this in lettings that we have done this year, where we're basically able to call rent. This is a landlord's market, and therefore, from a leasing perspective, in a lot of cases, the tenant wanting to sign a lease to put take a more legal situation. There is competition out there, they have to move fast, and therefore rents are moving up. So whether it's on a lease or a property that becomes vacant, or whether it's on a new development where the development costs are going up, rents are going up.
Okay, good. Well, I just wanted to pick up with you in terms of spec. Are you seeing changes in, I suppose, the spec that also your leaseholders are looking for, but also DHL are looking for? Are there things that you're expecting to see that also, Mike and Nick will have to look to change in the coming years?
So our base build spec that we're working to is, I'd like to say very high. It's hard to compare apples and apples because it's kicking the tires on every single building you get through. But we've been gasless in all our environments where we're building out at the moment. We're looking to future-proof roofs. We've got battery storage ready, slabs going in. So
all of our own buildings, we are building to as high a possible spec as we can. That comes at cost, obviously, but it's something we can manage through our own potential occupation of those buildings. So I'd like to think that the DHL covenant still comes with some value. I mean, the big boxes that are on motorway junctions, Michael. Yeah, so for us, that's key. And in some instances, we're being driven by our client base. Sometimes we're having to drag them along. Cost is, a big driver to that, and fundamentally, there is an element of inflationary pressure that we end up driving through creating an increased rental market, because fundamentally it comes back to the products that everyone here buys in the shops. So there is a balance in all of that drive. There's a tipping point where it's less accretive to the sort of regeneration of our products, of the real estate that we're operating out of, because the stay put, in an existing building, which arguably, the embedded carbon scenario could be beneficial for that conversation, rather than going to a new one. But fundamentally, the operational side of it won't be as accretive to the ESG solutions we're working to. So it's a fine balance situation at the moment. I think everyone is, nearly all new build launches you see are targeting the very best. Carbon neutrality, BREEAM or Gold or LEED, LEED certifications. So I think the message is there that without it, you're not seeing the occupational demand. And the interesting bit that we probably lost the data point on was it would have been very nice for the path of the growth of value to continue that a little bit longer, just to see if there was a genuine, a green margin or a brand discount. We didn't quite get there. We probably saw a few deals that you could probably point to it, but that would have been a nice benchmark to really help drive that story as well. But obviously the rebasing has somewhat changed that. Whether that creates a more resilient product, those green buildings become more liquid going forward, wait and see to a bit of stabilisation. But fundamentally, it's key to all of our own buildings, and occupationally we have multiple pages within our BCAs, our business case assessments, going through of green agenda items that we have to address within our to get approvals for any leasing and likewise for any development. And if we're not there, we have to have very good reasons to why they're not being included.
Okay, just very briefly from you, Will, as well, just in terms of the discussion there around nearshoring, friendshoring. We'd already got partly that happening, an increase, because of things like Brexit and the issue with the Suez Canal and people being concerned about supply chains. But with all the geopolitics at the moment and the seeming kind of reversal of globalization, how much of an impact do you think that is going to have? What are you expecting to see in terms of increase of demand just from that nearshoring, friendshoring side?
That's
quite a big question.
I was going to say, that's quite an interesting one to try and pin the tail on that donkey, isn't it, in terms of where that lands. Clearly, we've seen significant shifts. There's been a lot more, rather than just in time. It's a product is being held in most geographies. I think that train is in track. I don't think that's going to shift much now. I think people have started to redevelop their supply chain solutions. So I don't think fundamentally people are going to take stock now and readdress that. I think that's maybe the bit that we're seeing maybe through the cost scenario is more people offering requesting RFPs through 3PL solutions. The cost piece is clearly a driver for them. One of the things we're looking to adopt through our developments is multi-user locations. So getting away from having that single big box that is just for a single one retailer who it's part branded us, part branded them. It's saying, right, well, you've got 50,000 pallets here, we've got 20, 30, 40, 50,000 other pallet spaces that we will cross-sell across our network to help mitigate those costs and enable those people to have that re-established and more resilient supply chain. So that's a bit of a round the houses way of saying I don't know how it's going to have an impact, but I think we're trying to create a platform that can benefit that or can facilitate that change at a more timely manner rather than having to build from scratch. So it's definitely something we're working with. I think everyone will see it across all of their occupations, that it's very much a differentiation between that sort of last mile element and the big box element. And obviously the big box tends to feed the last mile, so they go hand in hand, but they are ultimately two different asset classes that don't really operate in the same space as to how they function. So.
Okay, good, thanks. Just quickly for you, Marcus, as well, just in terms of the geographies, we obviously saw the key markets there, but I noticed, for example, that Poland was still quite high up. Are you seeing, in terms of the capital market side and the investment side, any impact for areas like Poland that are obviously much closer to Ukraine, for example? Are you seeing more of a wait and see, or is that not really impacting the market as much as you would expect? I suppose, because you would expect in some ways that would then drive more in, say, Spain or Portugal or Italy in a way.
Yeah, sure, and I'm conscious of time, so I'll be brief, but I've got on the capital market side, Poland stopped in its tracks, as you would expect, and I guess rightly so. It kind of became very difficult to digest what was going on very quickly. The good news is out there that the Polish economy is booming. There's been a bounce in occupier demand. There's so many stories to kind of get excited by Poland right now. Rental growth is coming through for the first time in years out there. The dynamics have shifted. The game of certain developers of playing chess with tenants, has been kind of stopped in its track because of the economics now in the appraisals. But there's going to be issues around liquidity, probably for years to come. I mean, as much as you can get kind of excited or draw some positives from the news the last 2 days with the kind of the Ukrainian push, that could reverse tomorrow, and you could have Russian tanks on the Polish border. And as you talk to, the big global investors that obviously have some bright risk and analysts sat in head office viewing things, they will just switch off when you start talking about Poland. They're kind of just see it too great a risk. Others, and typically those that have been in the market for a number of years, see an opportunity. And that is really where we're seeing activity start to come through again. But it's very much approached with caution, and it is slightly counter to what's going on occupationally. Rest of Europe kind of, let's enough educated people in the room to know what's going on, and I'm conscious of time. But I think, you're seeing certain markets ahead of the others. I'd say Netherlands, Germany, UK, probably because the yields got so tight, seem to have hit the hardest. Spain, Italy, one client said to me, it was like all the Spanish brokers got in a room and said everything's okay, let's not turn on the news. And it's going to trickle through there, shall we say. All of this kind of filters through, but probably because those markets didn't get so tight and debt still is accretive, they won't see quite the same severe drops as you've seen elsewhere.
Great, good, thanks. Does anybody have any questions? Feel free to put your hands up if you do. I'm going to count down in my head from 10 seconds. Yes, go ahead.
Probably what the markets are so broad, but who do you see as big winners and losers through this kind of volatility?
So that was big winners and losers in terms of volatility.
I'm just going to focus on winners. Sector specialists. As Michael said, the environment of the last few years has opened the door, or kind of a lot of people have pushed their way through the door to try and get access to this sector and the amazing growth story that we're all a part of. We're becoming more sophisticated, we've got to, and it's going to give rise to those that really know what they're doing. There's still a huge opportunity out there to take advantage of, but you've got to be a bit smarter and a bit cleverer in the way you go about it. I think as well, buying power of tenants, of materials, of contractors is going to favour the established bigger operators. We're hearing stories of contractors not willing to tender on pretty meaningful contracts just because it's not an established or one of their major customers, so they're going to be more selective on who they go to. So yeah, I think the winners will be the sector specialists.
Okay, great. Any other questions? Yeah, go ahead.
I have a question for Will. So you said your DHL winning new customer contracts with big companies. Is that a DHL thing because DHL is getting bigger and better, and the big caps getting squeezed out, or is that a wholesale sort of change?
I think it's just a case of not necessarily winning those contracts. I hope we will. Their RFQs are just coming out that there is more, appears to be more pipeline of opportunity for 3PLs. I don't necessarily think it's just, I'd like to think it was just us winning them, but no, it's just, I think there's a shift back towards, I think, the 3PL solution for a lot of people through, we have put that global buying power for the contractor and developer. We have that global supply chain. We've got footprints on the ground across the world. We can bring a lot of benefits through that, and so I think a lot of people are looking at 3PLs as that easier solution rather than trying to kickstart their complete regeneration of their own supply chain.
As I just comment on the back of that, what Will's just said, something we haven't talked about at all here today is automation, and how automation is becoming more and more standard. We are really seeing this grow, in particular 3PLs, and I think it's smart emphasis on what you were saying earlier about the shared use within buildings. I think that is something we're really starting to see, not just from DHL, but other 3PLs, potentially ultimately from the investors, because I think the technology, when data is better available, which is not really the plan, it's only its infancy to grow, I think that will prove, will allow more flexibility in these buildings, whether it's from a DHL or whoever, to be able to do this multi-share. That will be really efficient and play into the hands of a much more nimble supply chain, which is, I think, something we're seeing. The parties, data parties having the right building, the right locations, and the right operator who actually do it.
Just one point on the automation, that is also challenged by the same cost inflation we've seen everywhere. So there's that counter to that. It has to be well thought out and fit for purpose, and in the right building, basically. Because as with everyone, you want it to look a 20-year write down of the cost of that, just purely to make it the pallet rate sufficient. So it's a very good point. It's like everything, it's been sort of checked in its tracks a little bit while the cost of financing is addressed, shall we say.
We're seeing a lot of automation coming through from the sort of the very big occupiers, people like Puma, Wayfair, and Amazon, obviously. It also plays into the resilience piece we're talking about from a postcode, less resilience on people and more reliance on machinery, which is more likely.
Are you concerned on mid-caps? Yes or no? Mid-cap 3PLs, rising cost inflation, then EBITDAs. Is that a concern? Broaden the portfolio or as an investor?
Not particularly, no. I think that as long as they're obviously taking two steps back from that question, there's going to be more concern around the financials of tenants across our portfolio. We've seen the challenging economic times we face. Fundamentally, 3PLs, they're a good, well-run business. No. And so, talking about the buildings that we invest in, the lack of supply, we probably will lose volumes of the deal.
I can say that's, to that point, it's not necessarily about the 3PL. If the underlying client base is there, you'll have someone else step in and operate it within their platform, and fundamentally the supply-demand imbalance at the moment that doesn't, from everything we've seen, appear to be getting addressed anytime soon, means that the likelihood is that there'll be someone else to step in if that situation does arise. And there's likely to be some failures over the next 12 months, fundamentally.
We had an example just outside Frankfurt earlier this year where where 3PL lost a contract, and we took the lease back and released it at 25% higher rate for another 3PL, another contract. So I think that tells me.
Great. Any other questions? We're tight to the end of our time, but I've just got one last question, which is going to be the biggest change in the logistics sector over the last 12 months since we had the last census, and the biggest change that you're going to expect in the year ahead. And you've got, on average, 30 seconds each. So let's start with you, Marcus, down this end, and we'll work our way down to mine.
Well, in the last 12 months, the values have gone down. So we'll move on to the next 12 months. I think that we'll see some rebasing. I think my takeaway, we're all going to get a bit smarter. We're going to get more sophisticated. We're going to have a lot better understanding of what the buildings are doing, what role they have to play, what the value drivers are. I think, it's going to be a very quick maturing sector to be a part of. And you know, that's exciting for us as advisors. It gives us lots of opportunity to kind of differentiate ourselves. But I think generally kind of one size fits all and perpetual growth, we've realised is not such a thing. But as I say, going back to my earlier point, that does present an opportunity to those that know what they're doing.
Nick, echoing, looking back the last 12 months, it's all about interest rates and global uncertainty and everything which has crystallised where we are now. Hence, looking forward, I think that the issue, what we can expect to change, is more polarisation between the good and bad assets and locations. Because we, as I said, we are likely to see turnovers or more turnover. That will expose those, and this comes to Marx as one of our specialists, was generate valuable stocks actually as investors. I see that the occupation market will remain strong and right locations, right assets, will see good growth and good performance from the income side, notwithstanding the yields, which is
Yeah, echoing both those points, it's basically price and price really. It would appear that the rest of the fundamentals appear to be relatively consistent. Obviously, we've seen a significant rebasing. I think the next 12 months will be, a horrible term of price discovery, seeing where that settles down, levels out, and what that means for a kickstart on the next cycle, really, in terms of that pricing point.
Great, Mike.
What was the question again?
last 12 months and where you're
Well, the last 12 months have been extraordinary, haven't they? And I was just thinking back to Expo last year, and all the happy, smiling faces, and thought life would continue. As it had for some years, but I've said it already, I think huge changes, but this is creative destruction, this is a real opportunity for specialists, and that's the biggest change, just a complete change in market sentiment. But from our perspective, it's exciting, and this is where we can get back into what we've always done, which is create value rather than magic value on the back of yield compression. Because basically that's what's been going on. A lot of people have been kidding themselves that they're superstars, and reminds me of the various recessions in the past where some have come unstuck. But what's really interesting is that this is a sort of paradoxical market. This isn't a typical cycle for the logistics real estate piece, because in here we have, unlike 2008-9, very, very low vacancy, strong occupational demand, rising rents. Wow, that's fantastic. We simply have to buy well, invest wisely, and make money the old-fashioned way, with your brain, rather than relying on the market to do it for you.
Great, very interesting. And personally, Marcus, I'm also looking very much forward to becoming smarter in the next 12 months. So I mean, that's a good thing. Requirement for that. Thanks very much for joining us here. Thank you to the panel. Thank you also to Ollie and Mark and Kev for the presentations at the beginning. Really interesting. Those presentations will be available, so you can download those. And thank you very much also for joining us online. And if you're watching this on demand, thanks very much for watching. Thank you very much, everybody.